Friends, in today's video, we will discuss the Quant Flexi Cap Fund. When it comes to the fund's short-term returns or near-term returns, that is how it has been performing over 1 week, 1 month, 3 months, 6 months, and YTD, that is year to date. The performance across all these short-term time frames has been reasonable of this fund. It is performing close to the category averages, sometimes 1 or 2% below, and on other times 1 or 2% above. However, since January 1st till date, there has been a significant improvement in its YTD performance. During this period, while the category has declined by -6%, this fund has declined by only -2% and therefore has outperformed its category by 4% during this period. So where it underperformed by 11% over the past 1 year time frame, it is now outperforming the category by 4% in YTD, meaning it has already started delivering decent performance and has not only started matching its category average but also started outperforming it. This may be one of the best times to invest in any fund when it is coming out of its poor performance phase and has started delivering good returns. The reason is very clear. Since the fund had recently delivered very poor performance, its NAV dropped significantly, which is still available to you to invest and you can capitalize on this opportunity. Despite the recent recovery, it still offers you the opportunity to buy at the reduced NAV because the underperformance of 11% from the previous year compared to the category average has not been fully recovered. And despite this recovery, the NAV is still quite low if you invest from here. As you might be aware, performance of all funds under the Quant Mutual Fund house has been very good so far, if you exclude the exception of last year's performance. During the last year, all funds of Quant Mutual Fund house have performed poorly and underperformed their respective categories. The reason for this was the allegations of front running that emerged last year, which severely and negatively impacted the fund's investment strategy. The fund had to become defensive, abandoning its aggressive growth investment strategy for which it is known and which helped it generate such great returns in the past. All schemes of Quant Mutual Fund house follow an aggressive growth investment strategy, but they had to leave that behind. However, all funds under Quant Mutual Fund house, including this one, are now gradually recovering from that setback. This fund has started showing good performance from this calendar year, that is from January 1st till date. Further, if you look at its long-term performance, excluding the 1 year performance where it has underperformed along with the other funds from the Quant Mutual Fund house, this fund has delivered outstanding performance in all time frames, 2 years, 3 years, 5 years or 10 years, and has beaten its category averages with a decent margin. Particularly in the long-term time horizon of 10 years, it has outperformed its category by a huge margin of 5%. While the category has given returns of just 14% in 10 years, this fund has generated returns of 19%, and here too, it is worth noting that these returns are despite last year's poor performance, where it underperformed the category by 11%. Because as you know, when a fund underperforms in any 1 year, it negatively affects its performance across all time frames. Even after adjusting for that negative performance, the fund has outperformed the category by 5% in the 10-year time frame and delivered 19% returns over 10 years. This is a big deal for a flexi cap fund. In fact, this return is even higher than the Parag Parikh Flexi Cap Fund's 10-year returns, which is considered one of the best funds in the Flexi Cap Fund category. Now, if we discuss how the funds under Quant Mutual Fund house delivered such good performance and how this fund too delivered such good returns in every time frame, then this is because all funds under Quant Mutual Fund house, including Quant Flexi Cap Fund, follow a growth investment strategy. Characteristic of growth investment strategy is that funds following this strategy maintain a very concentrated portfolio, meaning the number of shares in their portfolio is quite less. As a result, their returns do not get diluted. Alongside that, they invest in growth shares, meaning shares that trade at high PE ratios in the market due to their higher growth potential. For instance, in the Flexi Cap Fund category, the average number of shares in portfolio is 61, while the Quant Flexi Cap Fund has only 35 shares in its portfolio. So it has almost half the number of shares compared to the category average. Its PE ratio is 24, which isn't excessively high. However, there are other funds, including the Parag Parikh Flexi Cap Fund, whose P ratio is around just 18. So, from this angle, this fund is still following a fairly aggressive investment strategy. But its investment strategy is not yet as aggressive as it used to be before the front running allegations surfaced last year. Gradually, though, the fund is returning to its aggressive investment strategy and growth investment approach, which is why we are now seeing improvement in its returns. However, it hasn't fully returned to its growth investment strategy yet, which is evident from the market cap allocation of this fund. As in the flexi cap fund category, the average allocation to large cap shares is 63%, whereas this fund has invested 77% in large cap share. That is 14% more than the category average. This indicates that the fund is still quite defensive. Because after the front running allegations last year, the fund had to become defensive and move more into large cap stocks. So that in case of redemption pressure, exiting from large cap shares would be easier compared to mid cap or small cap shares. That is why the fund has allocated a lot more to large cap shares and has also started holding a good amount of cash and debt to protect itself from redemption pressure. Its equity investment has reduced significantly. However, now the fund is gradually coming out of that situation. Currently, the fund is 92% invested in equities. So, in conclusion, the Quant Flexi Cap Fund is a good fund and has shown decent performance across all time frames, with the only exception being the 1 year time frame, where the performance was poor, and the reason for that is also very clear. The front running allegations against the fund house disrupted their investment strategy, and as a result, all their funds delivered poor performances in the past 1 year time frame for its investors, particularly for those investors who want to make a fresh investment through lump sum or SIP. It is offering a chance to invest in a good fund at a significantly dropped NAV. Also, fund has already started showing good performance as discussed earlier. Its YTD returns have been quite good, and even in other time frames like 1 month, 3 months, 6 months, and even 1 week, which is a very short time frame, it is performing close to category averages. In fact, in YTD, it has outperformed category average by 4%, whereas last year it has underperformed category averages by 11%. So this is a very clear sign that the fund is now coming out of its underperformance and has not only started meeting category averages but also started outperforming them. This could be a good opportunity for those investors who are ready to experience some volatility in the market, because this fund follows a growth investment strategy, and funds that follow growth strategies tend to be a bit more volatile compared to funds that follow value investment strategies like the Parag Parikh Flexi Cap Fund. However, the advantage of investing in funds that follow aggressive growth investment strategy is that they offer better returns compared to the ones that follow value investment strategies in long term. This video is only for educational purposes and is not an investment advice or recommendation. Always conduct your own research or consult a financial advisor before making any investment decisions.